Good evening and welcome to ShareSoc's webinar focusing on our Woodford campaign and more specifically perhaps on the Leaday legal claim which has recently been announced. Your presenters this evening, myself, I will be chairing. I'm the chairman of ShareSoc. ShareSoc has taken an interesting position on the Woodford claim in that we actually endorsing the Leaday action. Boz Michalowska-Howells, who is the lead partner at Leaday. David Ricketts, who is a financial journalist who has been at the financial journalist at the Financial News and previously at the FT and at Pensions Week. And finally, Cliff Waite, who is Policy Director at ShareSoc and who looks after the Woodford campaign. The disclaimer is important tonight because we will be talking about legal matters. And I want to make it clear that we're not making any formal accusations of anybody here. Leaday has done its work and is of the view that there is a case that can be taken forward. It's gone further than that and has obtained funding to take that claim forward and obtained insurance after the event insurance to cover that claim. But what we're talking about here is really the circumstances that have led up to the Woodford failure, the options that are available to investors in terms of potential redress, and the process of becoming involved in either the Leaday claim or any other route for redress. We're not giving advice here. And in fact, more specifically, when we come to the question and answers session, I would ask that people avoid taking us into very personal situations because neither we nor Michaela are going to be in a situation, sorry, Boz are going to be in a situation where, in a position where we can give you specific advice. So if you have personal situations that you want us to look at, feel free to contact Leaday directly or feel free to contact us directly outside the webinar. Next slide, please. So a little bit about ShareSoc. We are a not-for-profit membership organization who look after the interests of individual investors. We are run by investors. Our directors are unpaid. What we try to do is improve the investment experience, not only for our members, but for individual investors in the UK in general. And we do that through several routes. What's relevant for tonight is the campaigning process. And what we do is we watch what's going on in the markets. We watch what companies are doing, watch what regulators are doing. We watch what financial intermediaries are doing. And if we don't like something, then we make a noise. And we have very good access to government. Our patron is Lord Lee of Trafford, John Lee of the FT, and he provides us with unparalleled access where we need it. We have access to regulators, we have access to the press, and we also have access to companies. So our role here is to champion the interests of investors, and that's very important for the Woodford situation. But away from that, we also provide services to our members, information services. We run webinars, seminars when COVID allows, company visits. We produce a newsletter, more or less monthly. We have consistent blogs on the website, and we produce, often with the help of our own members, AGM reports and remuneration reports. We educate, again, on the website. you will find the Investor Academy, the ShareSoc Investor Academy, which is a useful resource for anybody looking at investing, whether you're novice, intermediate, or expert. We create networking opportunities. We run online forums, we run seminars, and we also merged last year with Signet, which is another investor organization where groups of like-minded investors get together and discuss their portfolios, they discuss the specifics of investments, and it's a self-educational process. And then finally, we look to save you money through discounts on services such as Stockopedia and Research Tree. You're going to hear several times tonight a request for you to support us by joining us as a full member. It's £45 per annum, and we think that that's excellent value for the amount of benefit that an investor can receive from us. Just on the monetary front, you're also going to hear Cliff, when he starts speaking to you about our financial situation, you'll hear violins start playing in the background, and he will pull at your heartstrings and suggest that we are very impecunious and that you need to be paying for membership and giving us donations. But against that, I should make a point that we have actually entered into a financial arrangement with Lee Day, where we receive an amount of money which helps us with putting up the forums, the website, and the campaign for this particular activity. But what I also need to do is make sure that it is fully understood that our due diligence on the various legal processes that are building around Woodford and our analysis of which of those we are most comfortable with, and specifically our conclusion that it is in the interests of investors, of Woodford investors, Woodford Equity Investment Fund investors, specifically at this stage, to join the Lee Day claim was separate, was a process that was undertaken separately from any financial discussions. So we have looked at what is going on. We have concluded that there is a process that is going on that we can put our shoulder behind and can support. And then as a result of that decision process, there have been some discussions on funding. So we're not quite as impecunious in terms of this particular campaign as we often are. And for the purposes of full transparency, people should understand that there is a financial arrangement. Next slide, please. So today, the only button that's going to be relevant to you, I'm afraid, is the Q&A button. If you wish to place questions for any of the speakers, please use the Q&A. If you use the raise hand button, hopefully it's been disabled, but very often it's not. If you use that button, I won't see it and I won't be able to respond. And the chat function allows participants to discuss between themselves. That also has been turned off because we find it quite distracting for participants. We prefer that you listen to the panelists and that you direct your questions to the panel. I will try to run through the questions as they run through all the questions that arise. Very often I find that those questions are in similar vein, and so I try and group them together. Occasionally we find that we can't get through all the questions in a session, and we try to get back to the questioner where we can identify them after the event and give them an answer. So that is your way of communicating with us tonight. Next slide, please. So I've done a gentle introduction. I'm going to ask the participants to open up their video screens as I go. So I am Mark Northway, Chairman of ShareSoc. Cliff Waite is Director of ShareSoc and runs our policy and campaigns activities, and he is responsible for this particular campaign. David Ricketts, who has lost control of his video, is financial journalist. he has been following the Woodford campaign, and he has in fact written a book entitled When the Fund Stops, and that book will be coming out in January. He has a wealth of knowledge about what happened in the Woodford debacle, how we got to the sorry state of events that we find ourselves in, and I think you'll find it an interesting run through the history to date. And then finally, Bos Michalowska-Howells is lead partner at Lee Day, and she will describe the Lee Day claim. She will describe the team at Lee Day. She'll give you an insight into what a funded claim means, how that funding works, and she'll tell you what to do next in order to join up. And then finally, we will have questions and answers. So I'm going to hand over to Cliff now. And
good evening. Thank you, Mark. The reason that ShareSoc is involved in the Woodford campaign is because ShareSoc is on the side of the investor. Unlike the lawyers and the providers of finance, we are not seeking to make profit. ShareSoc is a not-for-profit organisation which aims to improve the way that things work on behalf of the individual investor. As we are independent, ShareSoc can be a trusted sounding board to claimants. ShareSoc has a track record of success in campaigns. With the Royal Bank of Scotland, we got our shareholder resolution on the AGM agenda and forced them to have regular meetings and engage with retail shareholders. At Aviva, who were forced to U-turn on their plan to buy out their irredeemable preference shares at below market value. At Unilever, who had to abandon plans to move their headquarters. At Sirius Minerals, we got meetings organised between unhappy shareholders and the company and with Anglo American. And we also got the Law Commission, the Minister and a High Court judge to acknowledge the problems of people who hold shares via nominees. At Edge, we requisitioned shareholder resolutions and got an independent director appointed. At Albion, we negotiated a reduction in fees. At Beaufort, where PwC had proposed 100 million fees to resolve the frozen accounts, we were able to get this amount significantly reduced. At SVS, where investors have had their investments frozen, we are currently working to resolve many practical problems so that members can access their funds as quickly as possible. We are the only organisation that runs this type of campaign. The reason we can do this is because we have so many of the pieces of the jigsaw in place. We can help communications via our forums, which require both software and practical implementation expertise. We have the know-how and the track record of success. We are recognised as a powerful shareholder organisation. Our strong press links enable us to put forward key points. We can mobilise MPs via letter writing campaigns, such as we did at Sirius. We have able directors and volunteers, and we have the project management skills to get things done. We are not just a talking shop. We have established links and access to key influencers in government, the FCA, FRC, BEIS, London Stock Exchange, etc. And where necessary, we can bring on board partners like Lee Day. Next slide, please. The Woodford campaign has 4 elements. Communication to and between claimants in a safe environment. Compensation. Potential claimants may get back 70% of what you've lost. Those who do not join a claim will receive nothing. Those who have done bad things should be brought to justice. At the very least, they should be held to account. That is one of our guiding principles. In the case of Woodford, it may be that several of those will escape justice, but I will promise that we will do our level best to make it happen. We will be campaigning to change the regulations. We've recently submitted a 49-page report to the FCA's call for input on the consumer investment market. This is just one example of how we campaign on behalf of individual investors. So don't forget to join the campaign. Remember, it is separate to the Lead A claim, and so you can join both of these. They have different objectives. Next slide, please. As Mark said, this is the first time that ShareSoc has endorsed a legal firm in a claim. We did this only after much careful consideration. We looked at counsel's opinion as to the chances of a successful outcome and the rationale behind that counsel's opinion. We evaluated the status and reputation of 5 legal firms and their track records in similar types of cases. We were aware of other problems in other claims, like the RBS Shareholder Action Group, where there was an upfront payment. And so we're keen that the claim involves no such payment, and it doesn't. The level of cost cap is important, as the more money that goes to the lawyers and legal funders, the less is available to claimants. And in this case, claimants may get back 70% of what you've lost. And we looked at the mechanism for distribution of any award to make sure there's no strange contractual clauses which would limit the amounts you might get paid. And having examined all these factors, ShareSoc is pleased to endorse the Lead A claim. Next slide, please. I recommend you visit the Claimants Forum on the ShareSoc website, where claimants can raise questions or simply submit their views and engage in discussion and debate with other claimants. Now, this forum is based on the model which we've successfully used with our campaigns for Sirius and SVS. Our forum is moderated, and any comments which are libelous or threaten individuals or prejudicial to the case will be removed. This is unlike many forums and bulletin boards, which are full of, quite frankly, nutters and rude people and really waste your time. We believe that we have what we have in combination is unique. Can I have the next slide, please? And it adds huge value to the process of the claim and also to the campaign to reform regulation and hold to account those who have done wrong. So having made those points, I'm now going to pass over to David Ricketts, who, as Marcus said, has written extensively about this. And I've read his book. It's a wonderful book. I think it should be the required reading for all school children to teach them the basics of how financial investments work. Thank you, Dave.
Well, thank you very much, Cliff, for that kind introduction. I hadn't thought my book would be recommended to school children. I'll bear that in mind over Christmas. I'll hand that to my 5-year-old daughter. Perhaps she'll be pleased to receive a copy on Christmas Day. Now, good evening to everyone. And Cliff asked if I would provide an overview, essentially, about what went wrong for Neil Woodford and how investors have really found themselves in this situation, which really is an outcome that arguably would have been inconceivable 6 years ago, when Woodford announced that he was setting up his own investment empire and launched the flagship equity income fund, which I'm sure that you're all aware of. Now, I was approached back in January of this year to write a book focused on Neil Woodford's downfall, following some of my coverage of the fund suspension and also his business collapse in October last year. As Cliff said, the book is out next month. You can buy it from all good bookshops. Now, the aim really is to tell the full story of what went wrong in as much detail as possible, going behind the scenes where I can and giving a detailed account of what went on. But I also wanted to really chart the rise of Neil Woodford as much as his downfall, because I think it's very important to understand just why the implosion of Woodford's business was such a shock, not only to retail investors, like many of you tuning in here, but also to the financial services community and the City of London more widely. I've been a financial journalist covering the fund management sector for more than 10 years now, and Neil Woodford has always been one of the big names in the sector that every financial journalist has followed. And I've got a slide with a few headlines there that they can be pulled up, but you can see from some of these headlines just how much of a star Neil Woodford was, and arguably for good reason. There's a well-publicised figure that investors who put £1,000 with Woodford when he started at Invesco back in 1988 would have seen that sum grow to around £25,000 during the 25 years that he was with the firm. So arguably any investor would be happy with that return. Woodford really made his name at Invesco during the mid to late 90s and became something of an overnight success, if you like, when the dot-com bubble burst in 2000. He was one of the few fund managers that wasn't piling into tech and internet companies at the same time as some of his peers. He received a lot of flack for not following the herd. Financial advisors were questioning his decision not to take part in the growing buzz around the tech sector at the time. And instead he chose to stick by some of the familiar companies that had held him in good stead for many years, so including tobacco stocks, which really added value performance to his funds during the late 90s. So after avoiding being burned by the dot-com crash, Woodford went on to achieve further success during the onset of the global financial crisis. He didn't hold any bank stocks at the time, which was quite rare. So again, he managed to escape a lot of the fallout where lenders like RBS were plunged into crisis. And by this point, people were thinking, this guy has something of a Midas touch. He was dubbed the Oracle of Oxford, a reference to Warren Buffett, who I'm sure many of you will know as the Sage of Omaha, one of the world's most successful investors, and indeed actually one of Woodford's idols. So there was no surprise when Woodford decided he was going to leave Invesco in October 2013 that his announcement caught the investment community and investors off guard. He announced he was going to strike out on his own and set up his own business. One of his former colleagues, a guy called Craig Newman, was to join him as CEO of the business and also a partner in the new firm. And they later recruited a band of former Invesco colleagues to join them. So I think to say it was a surprise that he was leaving Invesco is probably an understatement. But from speaking to former colleagues who worked with Woodford at Invesco in Henley, he wanted more freedom to invest in some of the companies that he thought offered the greatest potential. So some of these were companies that were smaller and perhaps less liquid. So a bit of a departure from the large blue chip firms that he'd backed previously. And often investing in these kind of companies could be quite difficult in a large organization where you've got an overbearing compliance team asking a lot of questions. And he really was the kind of standout manager at Invesco and was responsible for a lot of their success. By the time that he announced his departure, he was overseeing £33 billion across his two main funds, the High Income and Income Fund, which many of you may have been invested in while he was at Invesco. And it was a huge chunk of Invesco's overall assets, which were around 75 billion at the time. Now, the expectation was that Invesco clients would follow Woodford out of the door to his new outfit, and some of you may have done that. And while we can't prove that investors did leave those funds at Invesco and switch straight into his new fund at Woodford Investment Management, the Invesco funds did see huge outflows in the months following his departure being announced. Now, the announcement was made early 2014 that Woodford would launch his first fund, the Equity Income Fund, which is, of course, the fund that has gained the most attention. And that fund was launched in June 2014. Now, Woodford negotiated an exclusive fee arrangement with Hargreaves Lansdown, the investment platform, meaning it was the cheapest way to gain access to that new fund. And there was very heavy promotion around the fund's launch. It was backed by Peter Hargreaves, one of the platform's co-founders, Mark Dampier, who was head of investment research at Hargreaves Lansdown, also championed the fund. And Hargreaves Lansdown's own multi-manager funds, which some of you may be aware of. So these are funds that Hargreaves Lansdown run, but they invest in funds that are run by the managers that also invested into equity and income as well. So it was heavily featured on Hargreaves Lansdown. The influential Wealth 150 list also was a place where the fund was getting a lot of attention. It was on the list from the first day, so it gained the maximum exposure possible on Hargreaves Lansdown. And in total, Woodford's fund raised, it was 1.6 billion, I think, during the offer period between May and June, which made it the most successful fund launch, open-ended fund launch in the UK ever. So records were being broken, and things were going very well for Woodford. Performance was very good the first year or so. And then came the launch of the Woodford Income Focus and the Patient Capital Trust. Patient Capital Trust also broke records. I think it raised around 800 million when it was first launched in 2015. Again, another record for a UK investment trust launch. By May 2017, I would say, Woodford's business was firing on all cylinders. It was running in excess of 15 billion, and just over 10 billion of that was in the flagship equity income fund. And actually, in hindsight, May 2017 turned out to be the pinnacle for the business, and it wasn't really long after that that the cracks began to emerge. And the first sign of trouble, I would say, really came with a string of announcements from companies that Woodford held large positions in, beginning to post profit warnings. It really was quite a remarkable timeline over which some of these announcements occurred. One of the first was a company called Allied Mines, which is a US-based company, and it posted I think a 30% drop in its share price during one day in 2017, after announcing that it would change the way it was funding some of its subsidiary businesses. Now, Woodford had about 90 million invested in this company via equity income and patient capital. And I think the reports at the time suggest he was nursing around a £30 million paper loss following this one-day drop. So a huge impact from just one company. And without going into all the different companies that posted problems and profit warnings, there were similar steep share price falls at Provident Financial, AA Group, Purplebricks, AstraZeneca, companies that you may all be very aware of, but which really did deal a blow to Woodford's biggest fund. Now, obviously, on the back of all this, and if you were an investor in this fund, you would have been following performance quite closely. Investors really started to get jittery, and some wanted to cash in on their investments and get out of the fund rather than risk riding out the turbulence. And Woodford was now having to pay back millions of pounds every month to investors, including some large city institutions who had hundreds of millions of pounds tied up in the fund. So Jupiter Fund Management, one of the big city fund managers, was one of the most notable of these large investors, and they pulled I think around 300 million from equity income during 2017, given its concerns around performance. Now, this was obviously a huge sum of money, and again, another huge blow to Woodford, but it's important at this point to understand why these outflows were becoming more of a problem. So if I go back to his time at Invesco, you'll remember I mentioned that the vast majority of the companies that he invested in were large, well-known stocks, listed on the FTSE 100 and highly liquid, meaning that shares obviously could be bought and sold easily. And now he was the master of his own destiny. He could fulfill this desire to invest in smaller companies, and he did. And the Equity Income Fund had a long list of holdings that were arguably less well known, where shares were more difficult to trade, the likes of biotech companies, life sciences groups, companies developing treatments for obscure and rare diseases. And the list really did signal departure from Woodford's old way of investing at Invesco. And what made life more difficult for him was that the more investors wanted to cash out, the more he had to sell down some of his largest holdings in these more liquid companies. So this led to smaller, harder to trade companies in the portfolio becoming more prominent in the fund. And again, without going into too much detail here, investment funds in Europe are governed by rules which restrict the amount of assets that can be held in unquoted companies, a cap of 10% under the EU rules. Now, as Woodford started to sell down these largest holdings, he became very close to this 10% threshold. In fact, he breached it on a couple of occasions, what we call a passive breach. It was done inadvertently sometimes. A couple of things that Woodford did to try and address the unquoted exposure. The first was to transfer more than 70 million pounds of unquoted assets from the Equity Income Fund to the Patient Capital Trust. That was done fairly soon after the problem surfaced. But one of the manoeuvres which has got a lot of attention was to list some of the unquoted assets in equity income on the Guernsey Stock Exchange. So this meant essentially that Woodford could keep hold of some of these companies that he thought were still primed for growth, but it reduced the unquoted exposure in the Equity Income Fund. And that decision has gained a lot of attention in the subsequent months following the wind up. Now, matters really came to a head, I would say, in June 2019. This was when Kent County Council's pension fund, one of Woodford's most loyal investors, who'd been with him since his days at Invesco, wanted its £240 million investment back. Now, the pension fund trustees had grown increasingly concerned about performance of the fund, and that by this point, the assets in equity income were just over £3 billion, so down from that peak of 10 billion 2 years previously. So you can really see the drop in assets. Now, their request sparked the suspension, which obviously all investors were told about on June 3rd, 2019. But from conversations I've had with people close to Woodford and working with him at the time, the suspension really came as a surprise both to him and to Kent, who weren't expecting it. And I don't have time to go into all the detail here. I'm already taking up enough time talking about the background. But it's important to introduce another party, I think, at this point, and Boz will no doubt talk about them in more detail, and that's Link. So Link, what is called the authorised corporate director for Woodford's fund. So that sounds quite technical and quite an unsexy role, but they carry out an essential function. And the main duties really of an ACD, if you like, is to ensure investor interests are protected, the fund is meeting its regulatory obligations, and that the fund is essentially operating within the spirit of the rules. So when Woodford set up the equity income fund, Link was the firm he chose to act as the ACD. And it was Link, interestingly, who were accountable to the FCA, not Neil Woodford, the individual. He was the appointed fund manager, but it was Link who are the entity that is directly accountable to the regulator. Now, Link took the decision to suspend the fund, and that's when investors would have been informed that they could no longer buy or sell units in the fund. Now, the decision was made ultimately to allow Woodford to position the portfolio to more liquid companies, and that was meant to last for 28 days. And it's certainly within the rules to allow funds to suspend. We've had a few examples of that this year with property funds, for example, suspending with the onset of COVID. And I probably could say from this point on, following the suspension, that the rest is history. We know that the 28-day period was extended through August and September, and then the final decision was made by Link in October to wind down the fund altogether. And there's some debate about whether that was the right decision. From speaking to people who worked closely with Woodford, he was making good progress on positioning the fund to more liquid companies, and the expectation that he had was that he had until the end of 2019 to carry on with that work, and he was expecting the fund to open at the end of that year, and it never happened. Link ultimately decided that the progress was not being made fast enough, and they decided to wind up that fund. I'm just conscious of time. I just want to finish off with a couple of points, and I think people often ask me, and I think having written the book that kind of details all of this in certainly more detail, people often ask me who I think is to blame or should be held accountable for all of this, and whether any lessons have been learned from this whole episode. And I think it's not my job to point the finger of blame at any one individual or entity, but I do think there are a few key players here where questions will be asked. And I think Woodford is obviously one of those entities, and whether the fund was appropriate for retail investors given the holdings it had in smaller companies. Could he have turned things around? Should he have been allowed to perhaps have longer to position that portfolio to more liquid companies as he was expecting? Nobody could have predicted the year we've had this year, for example, but there is now an argument among some fund managers that the style of investment that Woodford employed, that's value investing, could be primed for a return. So maybe if Woodford had his time again, would he have actually managed to navigate those choppy waters and actually be on an upward trend now? Hindsight's a great thing. We will never know. I think Hargreaves Lansdown, again, they are an entity that comes into the equation quite a bit. Should the fund have been taken off the Wealth 150 list sooner when performance began to tank? They had a huge amount of money tied up in the fund. So, I think questions have been asked about Hargreaves in all of this. I'll leave it now for Boz to talk about Link, but obviously, they had a role in the fund suspension. and also the communication that's been going on with investors during the sell-off of some of the assets. And you know, there's an argument, I think, among some commentators about whether the process of selling off the assets in the fund has gone as well as expected. Has there been a fire sale of assets? You know, have some of the companies been sold off at a too cheap a price? I think I'll leave it there because I realise I'm rattling on for probably longer than I should have done. But that's just a brief, well, rather longer than I expected history of what happened. Cliff, I'll probably hand it back to you to introduce Boz.
My mic is unmuted, so I will do that. Boz, your slides are up, and the floor is yours. Your mic is off. Your mic is off. You need to unmute your microphone.
Yep.
Okay.
I'm unmuted it. Okay, thank you. Sorry. Right. Okay. So, thank you very much. May I first introduce myself? I think I'm not sure if we have the slides. Can I introduce the team? So, Lead are specialists in high-profile, large-scale group litigation on behalf of claimants. There are some quotes about our work on the slide. I'm Bożena Michałowska, commonly known as Boz. I've been with Lead for 23 years, and I'm head of the consumer law team. Now, you can see my full profile on the LD website, so I won't bore you with that now. But in summary, I've led on a large number of high-profile, large-scale, complex group claims. I'm currently was appointed as the joint lead solicitor by the court in the VW NOx emissions litigation. That's been described as the largest group claim in England and Wales, and also spearheading the Mercedes emissions litigation. Supporting me is a team of experienced solicitors and paralegals, but of course we are working with a team of barristers. Barristers we're working with are from 3 Verulam buildings. They're specialists in financial services litigation. We have Richard Edwards. He has been our lead. He's been involved in litigation against NatWest, Royal Bank of Scotland, HSBC. Now, he's an excellent advocate, and you're going to need that if this case is going to go to trial. And he's steeped in the subject matter and really comfortable with the scale of the case. Our junior is Tenny Onabanjo. Tenny, as with many of 3 Verulam buildings barristers, has completed secondments with the FCA. She's instructed to advise on both public and regulatory law matters, and she's been instructed to advise in relation to the handbook and regulatory reform generally, and on drafting of the Financial Services Act 2012. So, as a result, our barrister team has a real comprehensive knowledge of industry regulation. So we're also working with experts, Fideras. Sharestock are very familiar with them. They are an international economic consulting firm specialized in economic analysis of financial and competition litigation matters. There should be some numbers on the slides, and which should speak for themselves. Their research has underpinned some of the largest regulatory enforcement actions around the world, and their forensic investigative work was relied on in the RBS rights issues litigation, so you may know them from that. So we've got a solid and experienced team, a team with expertise in large and complex group litigation, and a team with expertise in financial litigation. So on the next slide should be our key elements of what are the key elements of a successful claim. So I'm just going to explain to you really what we need to establish, what we need to be able to have in place in order to bring a case like this. So we've estimated that there's likely to be there was about 600,000 individual investors in the equity income fund. Of which there's about, we believe, 270,000 individual direct investors. And obviously not everyone is going to want to bring a claim. But there's no dispute that the likely number of claimants will be very significant. And because of that number and the consequent total value of the claim, this case is likely to be heavily contested, and the claimants need to be prepared to go all the way to trial. The defendants are likely to instruct Magic Circle law firms, and therefore claimants need to make sure that they can match the defendant's firepower. So they need the resources in place to make sure they've got the best experts, the best barristers, and that they can see the case all the way through to trial. And claimants will want to do this on a no-win, no-fee. They've already had their fingers burnt. They don't want to be risking further investment going down the pan. So law firms and clients are going to need an external funder who is prepared to make a sufficient investment in the case to indemnify the claimant and enable the case to be taken all the way through to trial. So, but at the same time, you want to make sure that the claimant's compensation is not eaten up by the funder's return. Also, you've got to be aware that if you lose, the loser pays winner's costs. So you're at risk of having to pay defendant's legal fees. So what you need to have after the event insurance, which is, again, indemnify you in respect of that risk. So what do you need to get that? So you need the insurance in place is one that is crucial. That's even more important than funding, because you can't get a case off the ground without having after the event insurance in place. And I would really not recommend issuing proceedings or putting yourself at risk without having that security. So what do you need to get that funding and insurance? So you need a strong case strategy with very good prospects of success. You're going to need sufficient numbers and expected damages or compensation to make the investment and risk taken viable and worthwhile for the claimants and the funder. You need a strong case management strategy to take a case of this complexity and scale through to trial efficiently. And our own view on case management is that it's the only way to do this is via a group litigation order or a group action, where all affected claimants who've got a case that arises out of the same cause of action, they join together as a group and they share the risks, the costs and the benefits under the management of a steering committee of law firms. And last but not least, you need a law firm that can be trusted to take that case as a group all the way through to trial efficiently. So I think on the next slide, where are we on our shopping list? So we've spent a year investigating the possible causes of action and routes of redress, of which there are a number, and with counsel and with experts. And on the back of that research and our case strategy and our case management proposals, we are now in the advanced stages of negotiation with a funder. In fact, we received the litigation funding agreement this afternoon. So we hope to have that fully executed, hopefully before Christmas. That funding agreement is going to provide for legal fees, disbursements, and pay the premium for the after the event insurance, which is going to cover clients' adverse costs risk. Primarily, it gives us sufficient funding to take the claim through to trial. So they will be partially funding our fees. They're not going to pay all our fees, they're going to pay part of them, so that we can have the resources in place, we can build our team, we have sufficient manpower in place to be able to provide each client with a decent service. And it also enables us to bring this case on a conditional fee agreement or a no-win, no-fee. So in those circumstances, under a no-win, no-fee, many of you may be familiar with it already, what a no-win, no-fee agreement is, but the agreement that we've managed to negotiate with the funder enables us to be able to charge a maximum of 30% of damages, so 30% of people's compensation as a deduction to meet our success fee, the funder's fees and the insurance premium. and so that claimants can retain at least 70% of their damages when we're trying to get you more. Of course, if you lose, the clients don't pay us or the funder, but of course you are still, or the client, the claimant, is still in principle liable to pay the defendants. And in relation to defendants' adverse costs, I can confirm that we've received formal offers of insurance from after the event insurers. They are Litica, they're backed by Hiscox and AXA, and Harbour Underwriting Limited, backed by Hamilton Insurance DAC. All three underlying insurers are A-rated and above, and rated by top rating agencies. So in effect, we've got the expertise in place, we've got the funding package, we've got the resources, we've got a solid foundation on which to build a group action. So, and I can hear you saying, so what is your case? What is your case strategy? Who is your defendant? So on the next slide, as I said, we've spent a year investigating the possible causes of action and the routes of redress with our experts and counsel. The funders have also spent significant time doing their due diligence, interrogating our case strategy. And ultimately, we believe that the best prospect of establishing liability and obtaining compensation is on behalf of direct investors in WIF against Link Fund Solutions. Now, I appreciate that many people feel that Hargreaves Lansdown should be held accountable, or Neil Woodford himself. And I am not letting them off the hook. Excuse me, sorry. And there's a good claim against them. However, the better claim and the stronger claim, we believe, is against Link. That's my phone going. I do apologise. So, as you've already heard, Link was Woodford Equity Income's authorised corporate director. The role of the authorised corporate director, as you know, is an essential one in protecting the best interests of every investor in the fund. And primary amongst those is to ensure that the Woodford Equity Income, the fund itself, remained within its investment and borrowing powers and complied with FCA regulations in areas such as the 10% limit on unlisted holdings, and ensured proper valuation of all holdings, listed and unlisted. And so the rules of the FCA require funds such as Woodford to follow investment restrictions that are designed to protect investors. Among other things, those rules provided that the fund could only invest in securities only to the extent that they didn't compromise the ability to redeem shares. It also prevented Woodford Equity Income funds from holding more than 10% of its portfolio in unlisted companies, as David mentioned. These rules are designed to prevent the fund from investing in securities which would be difficult to sell and might therefore prevent investors from withdrawing their money from the fund. So our case in short is that Woodford Equity Income's excessive levels of illiquid or difficult to sell investments, the extent of which was particularly unusual when compared with comparable funds, significantly impaired liquidity. And the suspension of Woodford was triggered by redemption requests that the fund was unable to meet. So the FCA themselves indicated that the key causes of WIF suspension included the liquidity mismatch and Link's reluctance to offer a more assertive challenge to Woodford. So our case is that it was Link's failure to do their job to ensure the liquidity of the fund and protect clients' interests that led to investors suffering a significant loss. So that's our case. Our case strategy is the claim against Link for their failure to ensure the liquidity of the fund. So what compensation can claimants expect to get? So I think that's on the next slide. So ultimately, we are looking to get recovery for our clients for the losses that our clients have suffered following the capital redistribution, so the balance of what's left and unrecovered. So I think on the slide it does say that the losses to investors from the date of suspension, our assessment is that they range from 24 to 29.7%. And that range is determined by the cash raised through the sales of the fund's remaining assets. However, this is not the full extent of losses since purchase. In fact, losses since purchase of the they range from 43.5% to 47% for the Z income sterling shares, and for the Z sterling accumulation shares, that loss ranges from 36.7 to 41%. We're also arguing that clients are entitled to recover an element that would reflect the return on that investment. So what would they be entitled to expect? So if we move to the next slide, who is going to be able to pay for who's going to pay for this? Are Link going to be able to meet a judgment which is going to be in the region of 200 million at least? So who are Link? Who are they? So Link is a wholly owned subsidiary of Link Administration Holdings Limited. And they're an Australian company, and they have a revenue of 1.4 billion Australian dollars and a net operating cash flow of 339 million dollars, Australian dollars, as at year end in 2019. Link is an important company in the UK arm of the parent's Fund Solutions business. And on the 30th of June 2019, it operated 98 open-ended funds, and 81 alternative investment funds with respective assets whose their respective assets under management were 38.2 billion and 34.2 billion respectively. Now, Link appears to also be involved in the administration of other funds for which it's not the operator. But Link's own revenue is significantly smaller. In 2019, its revenue was 36 million and its income only 7 million. So it doesn't seem like a prospect that Link is going to be able to meet that large judgment. Is there a possibility of piercing the corporate veil? That's something that we're investigating. But should Link be unable to meet an award of damages against it, and its parents would allow it to go under, notwithstanding its importance to the parents' Fund Solution business, and it results in Link being in default, owing a civil liability, we can apply on our client's behalf to the financial compensation scheme for redress by them. So I suggest that you have a look at the FSCS website yourself, so you can familiarize yourself with how that works. I think I'm probably running out of time myself. So, but before I conclude, there should be a slide in relation to the Financial Ombudsman. And it's very important that I point out that individuals don't need to instruct a law firm or even join a group claim. They can bring their claim by themselves via the Financial Ombudsman. And that is a free service. So I urge you to look at that. Please be aware of the limitation periods that apply to bringing a claim via the Financial Ombudsman. I think I've probably, as I said, run over my time slot, and I'm sure there are many, many questions. Thank you for listening.
Oz, thank you very much indeed. And yes, I'd just like to reiterate the final slide. There are alternatives for investors. One that Boz mentioned is the Financial Ombudsman service. Another is an alternative claim, and we are aware of 5 claims routes that are opening up. We have put our flag on the Lee Day route, but it's up to investors to take a look and make their own view. And there is obviously the option of individual lawsuits where people feel justified in doing so. But I think what you will have taken away, hopefully today, is that the amounts involved are huge. The cost of bringing a suit is huge, and the sensible way of doing it, in our view, is to do it as a group claim with a no loss, a no win, no fee approach. There is an additional benefit to bringing in a funder, which is the due diligence part that Boz spoke about. In order for Lead A to have got to this point, they need to have persuaded a funder that it is sensible to come in alongside this, that they're going to make a sensible return on their cash, and they need to have persuaded an insurer that they're not going to lose their premium plus. So you've got multiple layers of commercial entities saying, yeah, we think this makes sense. And that from an investor's point of view, I think is a good part of the confidence that is needed to go forward. So thank you very much. I'm going to we were due to finish, but we've still got 146 people listening. So I'm going to run the questions beyond the time. And apologies if participants need to leave earlier. But I'm also going to try and bat away one or two questions before I open up. So there's a few people who are asking, what about patient capital? What about income focus? And the answer, I'm afraid, although the ShareSoc Woodford campaign is interested in anyone who has been hurt through investing via Woodford, the specific opportunity that is opened up for redress is limited to the Woodford Equity Income Fund at this stage. So there is, I'm afraid, those of you who, like myself, are in patient capital need to hold out for an alternative route if one becomes available. A recurring question is I think people look at the actions of Woodford, and there's a degree of anger in anyone who's lost money as a result of what's happened. The question that is frequently asked is why not against Woodford's, or what is left of Woodford's investment company, and why not against Woodford personally?
Why not against Woodford personally? Now, I am not letting Neil Woodford off the hook. The issue here is, what is the best prospect of success? Which case has the best prospect of success? Which case can have the backing of the after-the-event insurer and a funder? And I'm not saying that there's not a good claim against Hargreaves themselves. I'm not saying there's not a good claim against Neil Woodford. And I'm not, as I said, I'm not going to give them a let out in case they have somebody listening in. I'm not letting them off the hook. I'm just saying that the best prospects of success from our research is against Link Fund Solutions. I hope I answered your questions. The phone went. Sorry, I didn't hear.
No, that's exactly right. And I would just like to underline here. I mean, it comes to our motivation of involvement as well. This is not. I think it's a mistake to regard a process like this as a sort of punishment or revenge primarily. I mean, there's all sorts of motivations for a lawsuit, but our primary focus here is to look at where investors have lost money. Is there financial redress available to them, and what is the easiest way to, or what is the best way to achieve that? And I should perhaps broaden out slightly and say legal redress is very often an issue for ShareSoc. We have sort of philosophical questions about the concept of shareholders suing their own company, which is very often the way that claims, investor claims in our world develop, specifically because it ends up with the shareholders in company X effectively suing the shareholders in company X, and the money goes around in a big circle, and 30% of it is siphoned off to funders and lawyers. It's a very cynical view of it. But what we particularly like about this situation is that people that Lee Day is looking at going after are external. So there is no circularity involved here. It's the people. There is a capacity for the people who have been hurt, those who've been hurt as investors, to go after those who've been responsible for that hurt, and without damaging their own assets, which is an excellent route. Cliff, you wanted to say something?
Yes, well, it's not so much going after Neil Woodford, but it's going after Woodford Investment Limited, which is his firm. And this is a firm which paid significant dividends to Neil Woodford and his partner. And at a time when it was pretty clear that there were large questions being raised. And so this is something which the FCA and the FRC need to be looking at. And this is the sort of campaigning which ShareSoc do get involved with. And we will certainly be raising these issues with the FCA and the FRC as to why such dividend payments were allowed.
I think I'll just jump in on that, because I think actually you mentioned the FCA, and obviously people will be aware that the FCA launched an investigation shortly after the fund was suspended into the events that led up to the fund, or Link deciding to suspend that fund. It's a year and a half on now, and there's still no indication from the regulator about what happened. You know, any lessons have been learned from this whole saga. And I think that's a really important point that people need to be aware of, the fact that the regulator has taken so long to come to a conclusion. I mean, it doesn't sort of doesn't instill much confidence in the regulator. And obviously we saw Andrew Bailey at the Treasury Select Committee, and you know, Mark Carney made this famous quote during that time about you know, funds, open-ended funds that offer the promise of daily liquidity being built on a lie. This idea that you can invest in a fund but be promised your money back at a moment's notice. Clearly, you know, this is an example where that structure has not worked, and it would be interesting, I think, to see what lessons have been learned once we get an indication from the regulator. So I don't know whether in your conversations with the FCA, whether you ever raised the issue of the suspension and the investigation that was going on around that, but it would be good to get an idea about when a conclusion would be likely, because I certainly haven't had any luck trying to get an answer.
Yeah, they will not, the FCA will not talk about ongoing cases, because it might be prejudicial to the people who are being looked at. But you've also got to remember that if the FCA is investigating something, they've got to develop a case to a standard which would be sufficient to go in front of a high court, and similarly for the FRC when they're looking at people. So these cases do take ages and ages. It took it 10 years to look at HBOS, but you know, 2 or 3 years is going to be the requirement. But it's very interesting that Carillion, the Treasury Select Committee, managed to do a jolly good report in 3 or 4 months on that and publish it. But the FRC cannot actually find some way of doing this. I quite like the approach in the US, where the SEC gets people and dresses them up in pajamas with stripes down them, and balls and chains around their ankles, and makes an example of them. I think that people need to be made examples of, pour encourager les autres.
Right. Back to Boz. I'm afraid a lot of these are technical, and therefore I'm firing them in the same direction. There's an interesting question as to why. I mean, this is an OIC, an open-ended investment company, and therefore it has the concept of a board, and it has the concept of a an investors vote. So why was there no vote on the process of liquidation, or on the decision to liquidate, and on the process of liquidation? And I think we probably stray into David's territory as well, in terms of there was at least one suggestion of splitting this fund into 2 components: a good fund and a bad fund, and allowing the investors to enjoy the liquidity and continuation of the good fund, whilst disposing of the bad fund in the best and most sensible time frame. So there's probably two questions about the first one. Why no vote, Boz?
Why? I can't comment on that, I'm afraid. So I can't really go into the real details of our research and explain why things didn't happen. But ultimately, the key issue here is what was happening as it went along. Why the issue is what brought it to what caused the suspension of the fund. What caused the suspension of the fund is the illiquidity, not necessarily. We don't know what the outcome would have been had there been a vote. Had there been a vote, it may have been the same outcome. It may have still been suspended. So we need to focus on the illiquidity and the liquidity of the individual securities and how each security contributed to the overall liquidity of the fund.
Part of the issue here is who actually owned the units in the fund, and they were owned by nominees and not by the individuals, and this problem of the intermediated securities model. And this is again something which ShareSoc has been campaigning against for many, many years. And the Law Commission is actively looking at this, and it's published a report recently which highlighted these issues. So it is something which is being looked at.
And there is a side question that I'll pick up on the way through there, which is are nominee holders, and specifically ISA holders, considered direct investors for the purposes of the proposed action? In other words, if somebody holds WEIF in their ISA, you, Boz, I think will regard that as a direct investor, will you not?
Yeah.
Yes. Okay, so I can answer that. And David, if I can come back to you on this concept of the good fund, bad fund.
Yeah, this was an interesting development that came up in research for the book. So, speaking to people involved, around the fund, it was quite clear that things were going on behind the scenes at Hargreaves Lansdown to try and save the fund. I mean, obviously Hargreaves Lansdown coming for a lot of flack about having the fund on the Wealth 150 list, even though performance was tanking and concerns were being raised about the fund more generally. So why was that fund allowed to gain such a prominent position on that influential buy list? So what I found out during the research for the book was that actually a plan was put to Link by Hargreaves and Aberdeen Standard Investments, so a large asset management company that a lot of your viewers will probably be aware of. Essentially, yes, to take on the fund and split the assets into a good bucket and a bad bucket. So this is a concept that's been quite common in the financial crisis with good bank, bad bank assets. Because I think it's important to remember that not everyone in that fund wanted to get out. There would have been people in the fund that wanted to remain in there and have the option to redeem their holdings after the suspension was lifted. And as I mentioned in my remarks, the plan was for that fund to lift the suspension at the end of 2019 with a view to have enough liquidity to allow people out. So yes, this idea was put to Link and discussions took place. Apparently it was one of at least two solutions for the fund. So I think people lose sight of the fact that the work was going on behind the scenes to try and save it, but ultimately Link decided that it wasn't in the best interests of investors. And by the way, this happened before the announcement was made that the fund should be wound up. So this was during the sort of period between June and October. So Hargreaves and Aberdeen Standard went to Link with this plan during that period, but the Link ultimately decided it was in the best interests to wind that fund up and sack Woodford altogether.
That's quite an interesting and difficult to comprehend decision, that one, I have to say.
Very difficult decision, because it then led to a lot of the smaller quoted companies being shorted. Woodford published a list of all the companies which he invested in.
Yeah.
And what happens is that the professional investors spotted this opportunity, and it's a little bit like a coconut shy with a 303 rifle. It was an easy one to win, and the poor little private investor, yet again, got the short shrift here. And this is something which the FCA needs to look at as well.
Yeah.
Coming back to questions, thank you, Cliff. There's a few questions on timing, and particularly letter before action. I believe you have not yet issued a letter before action. And if you could answer that, and also how many claimants you have signed, and whether or not your council's opinion is viewable by participants.
Okay, so in terms of the letter before action, we have a letter before action that is in the process of being drafted, and we anticipate that that will be served in January. And once we will then enter into a period of pre-action correspondence with the defendant, and we obviously are going to try to achieve, if possible, as an early settlement of the litigation. So we will encourage the defendant to come to the table, speak to agree at the very minimum a case management protocol going forward, and to and if possible enter into roundtable discussions regarding settlement of the case. If we aren't able to have decent correspondence and decent discussion with Link, we will be forced to issue proceedings when we are ready to do so. We've got the after the event insurance in place. We do think we need to give as much chance of trying to have discussions with Link and narrow the issues between us as far as possible before we take that step. But we are ready to take that step, and we've got the insurance in place, and that's the key issue. In terms of numbers that we currently have got signed up on formal retainers 2,500 claimants. There are a number of other registrations of interest, and forgive me for not having that number. We haven't started a big marketing campaign, but we will, because obviously the issue is we need to have sufficient numbers in place. There needs to be a decent kind of cohort of claimants that can work together and take the matter through as by way of a group litigation order, by way of a group action. So to that extent, we will need to advertise for claimants. We will have to reach out for claimants to join the group so we can build a strong force behind litigation. And we anticipate being able to start that. We've got our media plan in place, and we're ready to press the button as soon as litigation funding agreements are executed. So you may be seeing adverts in, posters on billboards, etc. in the new year. What was the last question was?
The last one is whether council's opinion is viewable.
We won't be. No, we will not. That won't be. That is confidential.
Yeah, the question came.
We don't.
The question
be
came.
quite careful. Yeah. We have to be careful as to what we disclose, because ultimately things get into the wrong hands, and we don't want a document like that which sets out the pros and cons of our litigation getting into the wrong hands.
And I would add that we've started to promote this claim alongside Lee Day, and the Daily Mail the Mail on Sunday have run an article about it recently, a couple of weeks ago, and I think it was Investment News this week run an article on that. So we're beginning to build up a momentum ahead of steam about this, and then I think the number of claimants will rise exponentially.
Yeah, because we haven't done any advertising or anything like that. There's been no formal advertising, no formal real kind of social media being done. So we anticipate that the numbers, we have put some money towards social media, which has had some good feedback, but we will be, we get about 100 clients a day just on the back of word of mouth and articles in the newspaper and your own and ShareSock's own work.
Thank you. A couple of questions about the sort of all the other cases that are potentially being brought, and whether or not other companies are pursuing a claim to sue Link or Hargreaves Lansdown. And I think the answer is the names that appear on all of these are a mixture of Link, Hargreaves Lansdown. In some cases, I've seen Northern Trust, and one has hedged their bets and said possibly others. So there are there are claims that are looking at Hargreaves that are out there. Another question that has been brought up is, I've signed up with another claim, should I be jumping ship? And I'm not sure we're necessarily looking to push people to jump ship. And in fact, I think you need to look very closely at the documentation. If you have signed up to another claim, your ability to do that. And it may be that you don't have the ability to do that. Ultimately, the likelihood, and Boz, you'll stop me if I'm wrong, but the likelihood is that all of these claims will, to the extent that they are going, they're going after the same material actions, will come together. So the only fundamental difference will be the terms on which you signed up, and that was, I have to say, a very important part of our due diligence with Leigh Day. It is important that the total cost of this to the investor is kept low, so that the investor needs to be protected against costs coming and biting them. It needs to be ensured that the investor is not being asked to throw good money after bad, and it needs to be the case that a realistic proportion of any recovery comes to the investor. And we have one of the reasons why we are endorsing Leigh Day is because the proportion of any recovery that it will come back to the investor is sensible under the Leigh Day financing proposals. So by all means, if you're signed up with somebody else, take a look. If you're not happy, then you'll need to figure out whether or not you can jump ship. But ultimately, it's really just a question of, it's an efficiency and friction question. In terms of whether or not there will be a recovery, it's not a question of backing the wrong horse. It's just a question of the terms on which you back a horse. Boz, is that broadly fair?
It is broadly fair, but it's important to identify is that, who are they suing? Because our case management strategy is effectively that we will be progressing by way of a group litigation order. There will be a group register, and any, that group register will have all the claimants who can bring a claim that arises out of the same cause of action, and that will be against Link. They're following the same case strategy. So the defendant is Link. Other firms may not be following. They may be pursuing a claim against Hargreaves or Woodford. So those people that want to participate in the Leigh Day claim per se, they will be pursuing a claim against Link at this stage. It could be that we find a way of consolidating the cases, but we're not there yet. But those cases that are on the Link group action, those clients will be represented by lots of different lawyers. So there will be lots of different claimants represented by different firms. So it doesn't matter, as you said, who you have instructed, as long as they are following the same case strategy or they're following the same defendant, unless we find a way of consolidating all of the claims together under one roof, which we at this stage don't see a way of doing.
Thank you. A question here, which I think is an incorrect understanding. Somebody has said, to confirm, Boz says that we can put an individual financial ombudsman service claim as well as join the LD claim. I'm not sure that I heard that.
No, that's an option.
It's an either or.
It's an either or.
I am afraid that we're now nearly 30 minutes past our slot. We've lost some of our participants, but not all. For me, it's been very interesting, intriguing. There are a series of questions that I haven't been able to answer. We will try and do those.
We could put those on our forum, and so that people can see the answers.
Yeah, we'll try and lift them and put them in the forum and put answers where we have answers, but also where there are more individual questions. As I said, I think there's the ability to either ask questions of Leigh Day or ask questions of ShareSoc, and we can interact with you over specific. I mean, I've seen questions about inheritance. I've seen questions about positions that have been sold or bought at certain points in time, and those are very specific, and we can't, I'm afraid, answer them on a forum like this. But what I would like to do now, if I may, is thank my panelists very much indeed. It's a fascinating situation. it is one that it confused me why there wasn't a redress process forming earlier. It's very good to see that it is. It's very good to see that it's being sensibly constructed, and hopefully we see multiple outcomes from this. Hopefully we see recovery for investors. Hopefully we do see a degree of shaming of individuals and companies for their actions, and hopefully we see a regulatory reaction. We haven't really had time to go into it, and David, I apologize for that, but I think there's a whole field of whether the UCITS rules and the 10%, the ability to put 10% in illiquid assets is sensible at all. Whether the use by asset managers in the UK of open-ended funds for illiquid assets in the first place is a sensible place for them to be, and why the regulator hasn't taken earlier action on that. We're blessed in the UK with having a fantastic system of investment trusts, closed-ended listed funds, which are exactly the right receptacle for assets like this. Woodford could see it himself. He brought out he opened Woodford Patient Capital, which was the right vehicle to be investing in. But first he went down the OIC route. And why did he go down that? Because it was marketable. Why was it marketable? Because of this myth of daily liquidity, and this whole construct, this pack of cards needs to be addressed. Boz, David, Cliff, thank you very much indeed, and all of our attendees, many thanks for joining. Good evening.
Thank you.
Thank you very much.
Thank you.